Like and subscribe to my channel and click the bell icon to get new video updates.
Market volatility continues at The economy, stupid. Volatility in financial markets has continued over the past week. Stock indices are up about 2% on the week. After losing almost -3% in the previous week, they seem unable to lock in their direction. Similarly in bond markets, the 10-year T-note ended last year up 3.88%, falling to 3.40% by the end of January, before breaking through on March 1st 4%, and fell slightly to end the week at 3.96%. Such volatility is not surprising, given the mixed signals from the economic data tightening mode held. However, the market hesitation comes from an analysis of the underlying data. The headline data seems to be misleading. Take the payroll data for example. The January number was 517K, that's one seasonally adjusted number. The raw data was -2.505 million. Because seasonal adjustment factors are based on a long history, any significant change in current behavior will not be caught by the seasonal adjustment process for several years. Throughout 2022, companies have had a very difficult time finding employees. As the economy began to weaken, companies were reluctant to lay off employees. Instead, they have shifted to reduced working hours and part-time work. There's a sister survey to the headline-grabbing payroll survey Its called the Household Survey. That poll returned 84,000. Not 517,000 like his sister. The household survey distinguishes between part-time and full-time employment. According to this survey, there has been no increase in full-time jobs since May. All of the job growth in the second half of 2022 was part-time. The underlying data simply tells a different story. Returning to the seasonal adjustment process, it takes several years for the seasonal factors to recognize this type of fundamental change in behavior, so it is clear that the 517K was an exaggeration. In support, Endoran Pisadas, the country's top payroll processor, said they counted a total of 106,000 payslips, with small businesses actually chopping heads. The story is similar for retail sales. Sales in November and December were disappointing. As a result, more goods than normal went on sale in January, likely leading to the unexpected surge in retail sales in January. And the Census Bureau's index of economic activity is also signaling an economic slowdown, as seen on the right side of the chart below. Such chart patterns never appear outside of a recession. Existing home sales are falling, and when they fall, prices follow. The Shiller Home Price Index has fallen for 6 straight months, down a -9% annual rate since peaking in June. Economists sometimes refer to a phenomenon called the wealth effect. When people feel they have a significant nest egg, they are likely to spend more generously. But when they see that nest egg shrinking, they become more frugal. In the US and around the world, home prices have increased significantly during the pandemic period, but they have now started to contract. If this continues, the wealth effect will be more pronounced, more frugality on the part of consumers. The chart below shows the rapid decline in mortgage applications, both for purchase and for refinance. The refinance requests are important because borrowers are tapping into their estimated equity values, usually for the purchase of a large item, like an expensive vacation, a car or truck purchase, or a significant home improvement project. Note the slight increase in the dark line in January. This happened because the markets, much to the chagrin of the Fed, eased financial conditions in January, and as mentioned above, the 10-year Treasury bond yields fell in January. The mortgage interest rates are tied to a term of 10 years. As a result, many households took the opportunity and pulled the trigger to buy or refinance. Since then, as mentioned above, the fixed income markets have moved towards higher yields, which has pushed mortgage rates to even higher levels. As can be seen, mortgage applications continued to fall in February. The left side of the chart below shows the recent decline in single-family housing starts. Single-family homes have strong multiplier effects on the economy. Single-family housing starts fell -4.3% in January, and are now down more than -27% over the past year. Worse, new permit applications are declining faster. The gap between the two is widening. This implies that future launches will be even lower. The last time this happened was in mid-2007. 6 months later, Launches were down -28%, and the following year -43%. The chart below shows the rapid increase in the percentage of borrowers who are at least 60 days late on their car payments. Note the drop in such arrears in 2021. No doubt due to Uncle Sam's cash gifts. These have all been down lately. For example, the Dallas Fed Services Index was -9.3 in February. He has fallen in each of the last 9 months. The Chicago Fed has a national activity